Hello, everybody. Luke Gromen, FFTT. Hope everybody's well and had a great weekend. I apologize, I'm running a few minutes late here. I was trying to get the last little bit of the Browns touchdown drive there. So we're up 9 with 10 to play at Kansas City. So we'll see. We're looking like a pretty good football team this year. So that's something to be optimistic. So hope you had a great weekend. I'm going to jump in here. Speaking of football, first questions from my friend Brent Johnson. OSU versus Oregon. What happened? Well, two things. Obviously, our defense didn't play all that well. We gave up 250-something yards on the ground, which is something you're not going to win a lot of football games doing. However, as a lot of you know, I actually went to the University of Cincinnati, which is the second biggest school in the state of Ohio, and our football team is actually ranked higher than the Ohio State Buckeyes coming out of this weekend for the first time in a long, long time. So we'll see how long that lasts. So there is a silver lining for me there. So into the macro stuff. First off, from DC, comments on this. Harold Malmgren saying effectively no stimulus is coming. Harold knows. Harold is very tied in. Gentlemen, I've had the pleasure of the privilege, really, of meeting him a number of times, spending a number of hours talking with him. He's brilliant. He's very well tied in. He understands the political game. He's been in and around Washington for 60 plus years. If there is no stimulus coming, that's a big problem. And that is going to put pressure on the Fed to QE more. If they taper QE into no stimulus, and I'm saying a real taper, I'm not talking about, hey, we're going to taper with the left hand or we're going to do standing repo and the FEMA swap lines or FIMA swap lines and reverse repo with the right hand. I'm talking about real taper. Then any lack of enough stimulus or lack of stimulus at all will likely be very good for the dollar. It'd probably be good for treasury bonds. In other words, yields down at the long end of the curve, at least initially. It's likely to be very good for volatility and probably bad for just about everything else. Now, if they persist in that situation where the Fed continues to let global markets twist in the wind, then eventually it would actually start to be bad for treasuries, like we saw in March of 2020 when you saw yields rise after 12 days of the market being down sharply. And it'd probably start to be good for gold and Bitcoin as well. So let's see. If there's no stimulus, though, that is an important data point. Following up on that from DA, what is the most important thing to pay attention to for the next 6 months? I think for the next 6 months, it's probably are the Fed and Treasury going to do quote unquote enough? Now, what's enough? We'll know it when we see it, because if it's not enough, we'll see the dollar rising and a lot of other things falling. But I think more pressingly in the next 6 weeks, I think the most important things to pay attention to are what we're seeing in supply chains, which are getting worse and worse, and which we continue to hear are likely to be a much longer issue driving upward pressure on inflation than consensus currently believes. And the other thing I think we need to watch for is this, what we've been calling this great resignation, which is these vaccine mandates. Biden raised the ante last week, and they are making a bet that a large number or a quorum certainly, of critical employees in supply chain and in healthcare, etc., are not going to resign their jobs, resign and go find something else to do. And maybe they're right. However, I think it's going to be really critical to watch over the next 3 to 6 weeks, because if we start to see the job market get worse, if we start to see supply chain pressures get worse, the vaccine mandate has a possibility of being a stagflationary turbocharger to what's already a stagflationary environment. So let's watch and see what happens. From KW, you've spoken before about selling your farm partially to start FFTT. Is a farm something you'd be interested in owning again someday as part of a long, hard asset play? Have you looked into farmland, how farmland's performed during other times in history of financial repression and negative real rates? In short, yeah, it's absolutely something I would like to own again. I owned about 100 acres from, I think, 2011 to 2013. I would have held it longer, but I needed to sell the farmland for startup capital for FFTT because I didn't want to take outside investors, so I could have complete creative control to write what I felt like needed to be written and needed to be said. Farmland has tended to correlate with U.S. money supply over time, broad money supplies. Lynn Alden, my friend Lynn Alden, has actually done some great work around that. And so it is a good hedge of currency debasement. And the rental rate that you pull off of farmland correlates with crop prices on a lag. And so it tends to be a true inflation protected security, if you will. You don't have to trust what the government's telling you inflation is. You can just look at the price of corn and beans and wheat and say, okay, rent next year is going to be this, and that's it. And if corn and if all those things go up the year after that, you can raise rents. I was always very flexible with my friend who was a farmer. I like the phrase partnering with your business partners. So when crop prices fell, we cut rents and we worked out a deal because it's important. It was important to me for the farmer to make good money on running the land as much as it was for me to make a nice yield owning the land. So the other nice thing about farmland is that if it's treated properly, I think it's CRP is the tax program. The net of it was on that 100 acres, I was paying like $600 a year in property taxes. I don't know if that's still the case. That was nearly a decade ago now, obviously, but philosophically, the government does not tax farmland very highly because it just would filter through into higher food prices, which, as we know, food inflation triggers political unrest. So that's the reason for that. So next question from MV. Can a focus on public sector debts, excluding households and businesses, be misleading? For example, Rogoff and Reinhardt, in This Time is Different, only focus on government debts, and the U.S. government debt is often compared with 1945, but in 1945, businesses and households were in better shape back then. I guess it could be from the standpoint that if you're only looking at the federal government debt, but the household and business sector is also very levered, then I do think it actually is misleading from the standpoint that that you actually are in much worse fiscal shape because the household and business sector can't offset what's going on in the federal government sector. Ultimately, it means that real rates to get out of that situation probably would need to be even more negative. So if households and businesses are highly levered now, whereas they weren't during World War II, the federal government now is more levered than it was during World War II. After World War II, U.S. real rates had to go to negative 14% to help get out of, basically to financially repress, earn our way out of help the government delever their debt to GDP from, call it 110% to about 55% over a 5-year time frame. Real rates are widely considered to have bottomed at about negative 1.1, negative 1.2%, either in August of last year or a little bit earlier this year. Ultimately, if you've got debt at the household and business sector as well, it suggests it would have to get even more negative than that. So the other thing I think that's interesting within that as a side note is there's an old theory or old saw in credit ratings that no company or private organization within a sovereign can have a higher credit rating, at least sustainably, than the sovereign. So in other words, a corporation can't be AAA rated in America if the U.S. government's only AA rated. And that makes sense because ultimately, if you're a AAA rated corporation and the U.S. government's AA, they can always tax that corporation more to make ends meet. Whereas the reverse is not true for the corporation. So that's just sort of an interesting side note. And then last but not least, we received multiple questions about uranium and just talking about it. We talked about it probably for one of the first times in last week's Tree Rings. I am a newbie to the space, so take this with a block of salt, but I'm not a newbie to the energy side, in particularly, a theme we've been talking about for a number of well over a year, peak cheap oil coming back, which is that looks increasingly like there is a fossil fuel supply problem that is getting worse. And the general gist of it is that If you look at global oil supplies, they haven't risen much since 2005 if you X out U.S. shale. You've got some depletion rates. For example, there's a giant gas field in Europe. Groningen, I believe, is the name. I think it is in the Netherlands. And it is being shut down more rapidly than thought. And so you're running into, we're not longer just peak cheap oil, you're starting to have gas crunches in Europe, in the UK, in California. You're starting to run into this situation where narratives around green are running into reality of energy demand being infinite and some of the conveniences around it. So California is getting permission to turn natural gas turbines back on because as much as they want to be green, voters don't like when they're freezing in the dark or when they have to take cold showers. So I think it's an interesting theme as it relates back to uranium because ultimately you're looking at turning gas turbines back on, you're looking at peak cheap oil, you're looking at coal being burned in increasing amounts or lately because again, everybody wants to be green until they have to freeze in the dark. And when you have your constituents freezing in the dark, you don't get reelected. So I think, like I said, I'm very much a newbie to the uranium side. There looks to be some very structural positive demand drivers to it. I have not looked into the supply side at all. I know Sprott's doing something with an ETF where they're buying up a lot of supply. I do know I've paid a lot of attention what's happening on the fossil fuel supply side, along with the demand side. And from that side of it, it seems like it could be a really good environment for uranium from a structural standpoint. So with that, I'm going to sign off for tonight. I paused the Browns game, so no spoiler alerts, please. I'm hoping we're going to be able to pull it out for our first week 1 win since '04. In the meantime, if you like these updates, we are running a promotion. Check out Tree Rings. We're running a promotion on Tree Rings, FFTT-treerings.com. You can find out more about the promotion this week there. We get great feedback on that piece, as you guys know. I say every week, but we do. So it's fun to write, and our clients really appreciate it. 10 most interesting points with synopses of each to just try to help us all find our way of what's going on here. So again, FFTT-treerings.com for information on the promotion we're running on Tree Rings this week. Otherwise, everybody have a great week, and we will talk with you all soon. Take care, everybody.